What's going on, everyone? This is Gaurav and welcome to my learning channel. So in today's video, we'll learn about journal entries. But before we dive into the details, let's take an example to better understand the importance of journal entries. Now let's say that you own a lemonade stand. I mean, like, shocking, isn't it? The teacher came back with another example for lemonade. I mean, it's so original. Alright, I'm sorry, but I'll come up with a better example next time. Okay, so let's say as an owner of lemonade stand, you have to buy some lemons. So you pay some cash to get some lemon. And let's just say that you pay $100 to get like 100 lemons. So that's like your first transaction. Alright, now let's say that you have to buy some nice table and chair. Given your old one is broken and you want to trash them and you want to get something new. So you pick nice furniture for another $300. However, this time you didn't have money, so you asked the shopkeeper that you will pay them in 3 months, but you will also pay them extra $30. So shopkeeper agrees because it's a pretty good deal for them. They're getting $30 on top of the $300 sale, so they complete the transaction. So this is your second transaction. Now, as a business owner, you might want to record all of these transactions over a period of time because you do want to make sure that at some point in time, you would like to know, am I getting profitable? Is my overall business growing over a period of time or not? And what are some of the things that I can do to increase the overall efficiency of my processes? Now, one option is that you can just simply start writing all of these things in your notebook. So you could just simply say that on this particular date, I made a transaction where I bought lemons for about $100. And there's another transaction where I bought tables, which was worth like $300. But for now, I have only paid 100. And in like coming few months, I'm going to pay like another $230. Now, at a very small scale, this is probably fine because you will have probably 5 or 6 transactions in a week, and at max, you will have like 20 or 30 transactions in the entire month. However, now let's assume that you own 50 such joints all over the city, which means you have 50 different lemonade stands, in which case you will have to probably make like 50 to 60 transactions every single day. So this method of logging all of this information in your tiny little notebook is definitely going to become very unmanageable very soon. Now, this is where journaling comes into the picture. So it provides you with the set of rules which can potentially cover any type of a scenario you want to log the information, and so that you can access it later on and you will have all the information right in front of you without thinking too much. So how does this whole journaling thing work then? Let's take the same example, which is the 2 transactions that we just talked about. So for first transaction, we paid $100 to get 10 bags of a lemon. Let's try to put it in the ledger. So somewhat this is how your overall journal entry will look like. Let's just see that what are the different components to it. So over here, we can see that you have first thing which is written dr dot and then inventory. Then in front of it, I can see there's a number 100, and you have another one which is cr dot, which is for cash, and that's for another 100. So for this particular journal entry, that we can see that you have 2 different sections. So you have inventory and you have cash, and there's something called cr dot and dr dot. Now, as per our transaction, we did pay $100 to get $100 worth of lemon. Now, in our case, that $100 worth of lemon is nothing but inventory because we are going to use that. We are going to extract the juice out of that lemons and we're going to sell that as a lemonade. So you can call that those lemons are nothing but actually an inventory. So in this case, we can say that we credited cash for about $100 to get the inventory, and that inventory was for another $100. So you gave out cash, which was for $100, and you got the inventory in return, which was for $100. So in this case, the inventory was nothing but lemon. But now you might be thinking, what is cr dot and dr dot? So cr dot is nothing but credit and dr dot is nothing but debit. But then this sounds very counterintuitive because if we are giving out cash, then shouldn't we be debiting the account for cash, because debit means that you are actually giving out the cash. And similarly, if we are getting the inventory, then shouldn't we be crediting the inventory account rather than debiting it right over here? I mean, you're not wrong. It's true. That's how it should be intuitively. But unfortunately, it is not. And to be honest, I really don't know why. Now, almost always, I tell people to question everything. And for the most part, you will see that doing so will actually help you understand why things are done in a certain particular way. However, for this one, I would say just bear with me and memorize this one simple rule. So here's the rule. The rule states that if you have an asset and the asset is increasing, then you are going to debit that account. And if it is decreasing, then you are going to credit that account. So in our case, cash is an asset. Now, given the fact that we were giving out cash, we were giving cash to someone to buy the lemons, that's why the cash was decreasing, and that's why we credited the account. On the contrary, if we have a liability, then the rule reverses. So if you have a liability and the liability is increasing, so let's say if you take a loan or something like that, and your overall liability is increasing, then you are going to credit that account. And if it is decreasing, then you are going to debit that account. So I would just simply say that try to remember it only for asset, and liability is exact opposite of that anyway. So hopefully this is clear. Now let's take a look at the second transaction to make sure that we fully understand this concept. So in the second transaction, we said that we have taken a loan for $300 and because of which we got the asset for $300. Now I know that I said earlier that we did not take a loan for $300, but rather it was $330. So we have to treat the interest somehow as well. But for now, to make things simple, let's just say that you actually took a loan for only $300. $30 does not exist for the time being. So you can say that you have taken a loan for $300, which you said that you're going to pay in like 3 easy installments. And then afterwards, you got the asset, which was the table, which was worth $300. So as I said earlier, given the fact that loan is your liability and your liability is going up, we are going to credit that account. And that's why it is credit loan for $300. And given table is your asset, and as the asset goes up, the overall value for that particular asset gets debited. So that's why you have a debit entry for asset for about $300. So I hope this makes sense. These are some of the simplest journal entry that you'll probably see in your real life. Now in coming videos, we'll introduce the idea of T accounts. So in the next few videos, all of these things will tie up together. So always remember, the goal of journal entry is to not bore or worse scare anyone to death, but it is to provide the information in the right and consistent format to the decision maker to make the right decision. Although I must say that some of the accounting rule basically does it all. Alright, so that's all for now, and don't forget to check out the next video. Until then, goodbye.